Now let us continue with the bear spread strategy. The bear spread strategy is simply the flip side of the bull spread strategy. Suppose you are bearish on the stock, two possible things can happen. See, when you are bearish on the stock price, that means that the price might be going down, it's in the negative direction. So what you can do is to long or buy at the money put option to protect or to exercise it when the price goes down. At the same time, short or right at the money call option. So you can earn some premium, and since the price is going down, the short return call will never be exercised. So in this strategy, you are trying to make money by exercising the long at the money put option if the price falls, and gain the premium of the on the at the money call which you have written, which won't be exercised if the stock price is bearish. Well, what are the risks in this strategy? It's not a good strategy. Why? Because cost and risk of this strategy is firstly that the upfront cost of the put will be very expensive because the market is bearish. During right now, for example, right now, coronavirus and all these things, all the markets are down. It's moving towards the bearish situation. Right now, you go and try to buy a put option, it will be very expensive because the premium will be quite large. So you may have to spend a quite large amount on the premium to buy the put option, and you're going to earn a very little premium by writing a call option. Because no one is actually going to buy call option there because everybody know prices are going down. The direction is bearish, not bullish. So who is going to buy a call option? Of course, people will buy. Some people will buy, but the demand is so low until that you can't price it very highly. The premium will be very low. Alternatively, what we can do is to create a bear spread where you limit your up potential profit, and at the same time you limit your down loss also. So we can create a bear spread that limits the downside loss cost of the strategy by giving up a part of the upside profit. It is the same like the bull spread strategy, but reverse of it, a flip of it. Here we examine the put bear spreads. Call bear spreads also can be done in the same way, but let us consider on the put bear spreads. Okay, bear spreads with put options. Similar to what you constructed the bull spread option, but here this is moving in the negative direction. Bear spread using puts is a strategy where you can be bearish about the stock price, where you long a put at the highest strike of K2. When you long a put at the higher strike of K2, a small fall in the price will lead you to exercise the option. Probably you will be buying somewhere near to the spot price or at the money price. At the money price means the strike is equal to the spot price. Well, at the same time, say similarly, for the same maturity, you short a put option at a lower strike of K1, knowing that the large swing towards the lower side of the price may not reach up to K1, which means that you are building a strategy where you want to exercise the long option, but at the same time, you don't want the short put option guy to exercise it. That means the price may swing to downwards, but it may not be as large as to reach to K2 or the lower side of the strike. So at the inception, the K2 strike is chosen to be at or near the money. This makes the strategy very bearish. Selling the K1 put reduces the upfront cost of the strategy. See, of course, K2 is what you bought as a long put option. You have chosen that at near or at the money, as I told you. The minute the price falls a little bit, you can start exercising the K2 or the long put which you have purchased. But shorting the K1 is further down to the K1, K2. Therefore, the premium what you get from selling the K1 or the selling the put option at the lower strike will subsidize the cost of a high cost premium which you are paying for K2. It also caps the benefit or any benefit from the long put option K2 from the price decrease of K1 is now lost to pay the buyer of the short put at K1, which means generally, of course, your premium by paying for buying the K2 is subsidized by the premium what you receive in selling the K1. But however, if the price falls just below K2, it's wonderful, you can make some money. The maximum lowest cap there is K1 point. Up to K1, you will be able to exercise K2, that's your long put option. But even below that, you can still exercise. But at K1 point, you know that your short put option also will start to exercise. So you have to pay that. So your benefit from the ST below K2 limits at K1 point. Below K1, it will be neutralized by paying to the K1 option, right? The buyer, right? So let us see the payoff diagram, then you will understand it better. Okay, look at the diagram. You have three sections here. That the ST could fall below K1, that is the lower put price, or it can be between K1 and K2 is the highest strike price. Your strategy to build a bear spread is that you long a put at K2 at the highest strike at the money or near the money, and you short a put at K1. So basic idea, as I told you, during bearish time, long puts will cost you very high premium. And you can subsidize the premium by selling a short put at K1. But the trick is here that you know the negative swing of the price. Maybe right now the price is slightly above K2. If the price falls, and you know that in a short term, the volatility could not be that big until it reaches K1. So that's why you chose the K1 strike, knowing that it may not be exercised. If it's not exercised, you got no cost there. You can gain the premium, at least to subsidize the premium what you paid for the long put. Therefore, if the ST falls below K1, all these two options are exercised. The long put at K2 will be exercised where you get the money. The short put at K1 also will be exercised where you take the money what you gain from the long put at K2 and pay off the claims by the short put K1. So the profit is kept there. It neutralizes. But between K1 and K2, if the ST is between K1 and K2, this is where the profit is incremental. As the ST falls from K2 slowly towards K1, you can see the profit is incremental. You can see the red line there. The profit is incremental. It follows the same parallel path of the long put. Why is the parallel path of the long put? Because that part of the upward shift of the curve is the subsidized cost of the short put at K1, right? So what happens if the ST is below K2 or above K2, sorry, above K2? If ST is above K2, nothing is exercised. Long put has got no exercise, short put also has no exercise, very uneventful. Can you see? The ST could be in any of these three regions. The ST could be in below K1, or the ST can be in between K1 and K2, or the ST can be above K2. So look at the payoff table. designed based on that. You structure these into 4 columns. The first column is stock price range. Where does the ST falls? Second is the payoff from the long put option at the K2. And third is the payoff from the short put option at K1. And the last column is the total payoff. So since we are not using any numerical examples here, we don't have to calculate the profitability of it. So let's say first ST is below K1, the first proposition I told you. If ST is below K1, the only all the two options will be exercised. I told you that's the most eventful place where payoff from the long put option is K2 minus ST, and the payoff from the short put is ST minus K1 because you sold it. So if you take into account of these two, minus ST and plus ST cancels off. What is remaining is K2 minus K1. So the total payoff there is K2 minus K1. Okay, if the ST falls between K1 and K2, only the payoff from the long put option will be exercised, that K2 minus ST. Payoff from the short put option won't be exercised because it hasn't reached K1. So we are talking about ST between K1 and K2. So what is the total payoff there is only K2 minus ST. But the most uneventful place is ST above K2. The long put option won't be exercised. The short put option also won't be exercised. Therefore, the total payoff is 0, 0, 0, 0. That's the most uneventful place. Based on this, you will know if I ask you a question that I give you one high strike price and one low strike price, and I give you the current stock price, and I give you the dimensions of the direction, whether it's bullish or bearish, then I ask you to set up how to set a bear spread. Very easy, right? Let us look at a numerical example based on the bear spread. The example uses the following information. A hypothetical stock is trading as at the money S0 is $100. Current stock price is $100. 1 month call or put option on the stocks are both available with the strikes of $95, $100, and $105. The options have the following prices. At the strike price of 95, the call price is $6.95. The put price is 0.89. While at 100, that is at the money, $100, the call price is $3.09, and the put price is $2.67 per option. Well, the strike price at 105, the higher than at the money. Call price is $1.21, that's the lowest. Put price is the most expensive because you're buying lower than the strike. If it's an American option, you can immediately exercise it. $5.77. So now, let us take for an example, we continue with the same numerical example. Suppose that you're bearish about the stocks and you're considering of buying at the money put. Where is at the money? K equals to 100. So what happened to the key constant here is upfront cost is $2.67. Why? Because you saw in the chart earlier that at $100, the put price is $2.67. So you may have to wait for the price to decrease by $2.67 for the trade to be profitable, or at least to reach a break-even point. So how to reduce this? Possible alternative is to set up a spread, that is buy $100 strike put at $2.67. Same time and for the same maturity, you write a $95 strike put for 0.89. So what is the consequence? Your premium to buy the put option will be reduced. The cost will be reduced by 0.89. So 2.67 minus 0.89, it gives you only a premium of $1.78. So you don't have to wait for the price to fall by $2.67 to achieve break-even. Now you can just wait for 1.78, you can achieve break-even. But however, the up benefit is capped at 95. Why? Because the minute the ST reaches to K1 at $95, your gain from the put option, which you bought, the long put option, will be cancelled off to pay the short put option. If the price declines beyond K1, whatever gained in the $100 strike put is lost to the $95 strike put. In other words, as I told you, gains from the long put below K1 will be cancelled off to pay the $95 short put. If you think a price decrease below $95 is unlikely, that is the strategy. This trade-off will be good for you. The use of the bear spreads. When do you use the bear spreads? Like the bull spreads, bear spreads limit both sides. That's up potential profit as well as the downside risk. It may be used when the investor may have a negative or bullish view about the future price of the underlying stocks. But buying a put to limit the downside risk would be very costly during bearish sentiments. So therefore, you also write a second put option, at a lower strike with the idea that the lowest swing of the price may not reach to K1. Investors will use the proceeds of the K1 lower strike option sales price or the premium to substitute the high premium which you paid to buy the first put option at K2. Well, we'll resume again now. Consider the third spread. These are all vertical spreads. Well, the third one is butterfly spread. There's no real butterfly there, but the diagram creates like a butterfly with two wings. Consider three evenly spaced strike price. I said evenly spaced strike price. That means that K1, K2, K3. Specifically, the K2 is the real middle path between K1 and K3. So actually, to determine the K2, it is K1 plus K3 divided by 2. You'll get the K2. Can be created using either three call options or three put options, depending on the directions you are looking at. If it's a bullish direction, then you go for three call options. If it's a bearish direction, then you go for three put options. Written on the same stock with the same maturity, but different strikes. Okay? This is called a butterfly spread, where the portfolio constitutes three different options, either three puts or three calls. The idea is like this. First, long a call. Okay, we will look into only call options here. You can try it with the put options later. Long one call at K1, the lowest strike. Long another call at the highest strike is K3. And short two calls at the middle K2. So you long two calls and you short two calls here. All in got four calls. But you long one call at a lower strike price at K1. You long another call at the highest strike price at K3. But you short two calls at the same strike price in K2, the middle strike. Put butterfly spread is definitely exactly the same way, except that you replace the call to put. Diagram will look almost same, but of course the directions of the options will be different, automatically opposite. Two extreme strike prices are called the wings of the spread. Let us see the diagram, then you will understand. Okay, look here. No. The ST can be in four regions here. Because you have got a K1, K2, K3 equally spread, the ST can be below K1, where none of the options are exercised. And the ST can be between K1 and K2, where only the first call is exercised. Second call is not exercised. The the put option, the short calls also not exercised. But it can be between K2 and K3, where the first call is exercised, and the two short calls are also exercised, but the second call is not exercised yet. But the most extreme case is when the ST is above K3, all the options are exercised. Well, let us see the payoff table first, then we will know. See, now you're going to divide it into 5 columns. The first column, as usual, is the stock price range where the ST is going to be. The second column is the payoff from the first long call where the strike is K1. Second one is payoff from the highest long call at K3. And the third column is the payoff from the two short calls at K2. And then we have got the total payoff column. So as I told you, when the ST is below K1, none of the options are exercised. So it's all 0, 0, 0 throughout. But when the ST is above K1 but below K2, only the first long call is exercised. That's ST minus K1, and the other two are 0, 0. So the total payoff is ST minus K1. It's easy as that. But when the ST is between K2 and K1, the first long call option also will be exercised, that is ST minus K1. The second long call option won't be exercised, this will be remaining 0. The third two short calls will be exercised. Therefore, it is minus 2 because it's short. You put a minus sign there times ST minus K2. ST minus K2. In this case, it's 2 times because 2. So when you combine these two in calculation, of course, it will be minus 2 STs plus 1 ST. Remaining is minus 1 ST. And K2 minus K1 and minus 2 K2s will end up into K3. You will see when you use numerical values, you will know how it developed to K3. So K3 minus ST is the outcome there. Well, when the ST is above K3, all the options are exercised. The payoff from the first long call is ST minus K1. Payoff from the second long call is ST minus K3. And the payoff from the two short calls is minus 2 times ST minus K2. So if you calculate and see, it will become 0 again. So first ST minus plus the second ST, 2 STs, minus 2 STs. 2 positive STs minus ST becomes 0. Minus K1 minus K3 is 2 Ks there. Minus times minus become plus. Minus 2 Ks plus 2 Ks becomes 0. So these payoffs are calculated using the relationship where K2, as I told you, is 0.5 times K1 plus K2. Or in the diagram itself, I put a small notation there. K2 equals K1 plus K3 divided by 2. So the K2 strike, if I don't give you the exam question, you can still calculate it by looking at the K1 strike plus K3 strike and divided by 2, that's K2. Okay. So why this red line is below is because initially there could have been a small loss. You'll have got a negative payoff there, right? So that's why the wins are below 0. But between K1 and K2 is the incremental profit. The profit will last only until K2, where it start declining sharply because you have to pay off to 2 calls which you have short after that. But once it reaches K3, you have got the K2 paying off to you. So 2 calls are paying you to pay off the 2 shorts, so it neutralizes that, right? Can you understand? Okay, butterfly spread diagram is simply 3 strikes, and it's like a triangle up there and with 2 wings. Butterfly spread is a short volatility. You remember very well. This is a short volatility portfolio that is betting on the price of the underlying being at the neighborhood of K2. Either neighborhood of K2 mean below K2 or above K2, but the swing may not be so big that between K2 and K1 it may not reach below K1 or it may not reach above K2. K3, right? Uh, we ignore convexity relationship for that moment for this unit. Okay, then we go for combinations. Combination of calls and puts. Here we're going to concentrate only on straddles. We are not going to concentrate on anything else. The combination of a portfolio that uses both calls and puts. In order of discussion is that we first explore on straddles, then we explore on strangles. But anyway, I will concentrate only on straddles. What is a straddle? Straddle is a portfolio consisting of a long call and a long put on the same strike and same maturity. Whenever I ask you a question where one long call and one call and one put, you are longing both, have got the same strike and maturity, that means it is a straddle. Payoff function is maximum of ST minus K for the long and maximum of K minus ST for the short. Okay, this is how the diagram will look like. See, you have one long call at the K strike price, and you have one short call, one one long call and one long put on the same strike. So what happens here is both have got premiums to pay. So you combine both, you will have a very high premium to pay. That is why the break-even point, the lower point is a combination of two premiums. At the higher break-even point also is a combination of both the premiums. Let us look at a numerical example. Then you will know. Okay, the payoff table for the straddle is you can only check that there are only two possibilities of happening. Either the ST is below K or the ST is above K. The payoff from the call or payoff from the put. If the ST is below K, of course you're not going to exercise the call, so therefore it's 0. Payoff from the put is K minus ST. So the total payoff there is K minus ST. But if the ST is above K, you're going to exercise the call, the ST minus K, and you're not exercising the put, so it's ST minus K. It's very simple as that. Look at this. Very beautiful example. Consider a call option and a put option on a given stock, both with the same strike of $100. They cost $2.50 and $1.50 respectively, which means that the call option is $2.50 and the put option is $1.50. Explain how a straddle can be created from these two options. Draw the net payoff diagram for this strategy. State the trading ranges at the maturity in which the strategy gains profit. This is a very important question. The last sentence is a very important question. You have to make sure that you confirm the two break-even points where you will see above and below the break-even points it is profitable range. Straddle can be, see how you can form a straddle. A straddle can be formed by buying both put and a call costing 250 and 150 equals to $4, the total premium. The net payoff diagram will look like this. You have bought one call at 250. You have bought one more call or one more put at 150. So the 150 put will have a break even where 100 minus 150 is 98.5. But the long call will have 250 break even. So 100 plus 250 is 102.5. But your profitable range will have to take into account of both because you're buying both. So 250 plus 150 is $4. So your downside break-even point will be 100 minus 4, that is 96. And the up potential profit break-even point is 104. The strategy will make profit if the stock price at the maturity is less than 96, that below 96 or above 104. That's a beautiful answer you can give. Okay, when to use a straddle? Among the most important of all classes of option strategies, straddle looks to pure volatility play that neutralizes on the direction. Neutral on the direction. It can be either way, you will make money. Either it goes by positive direction, you will make money. If it goes by negative direction, also you will earn money. But you see, the swing is going to be a large swing because you have got uh, a larger break-even points both sides, and your profit range is above or below these break-even points. So therefore, the swing of the price should be large enough. Therefore, we say it's pure volatility play. Should be high volatility. If the price ranges goes up, then the call pays you off. The price goes down, the put pays you. Another way to see this is to note that a long call is bullish on direction and bullish on volatility as well. When I say bullish on direction and bullish on volatility means it is going to be in bull direction, positive direction. At the same time, the volatility jump is going to be quite large. Long put is bearish on direction and bullish on volatility. Large volatility. Bullish on volatility means the volatility is large. So bearish on direction and bullish on volatility. Therefore, straddle equal to long call plus long put has the direction bets cancelled out. Leaving bets on the volatility at the double magnitude volatility because two times it has to be bigger. Used in situations where there is no clear view of the direction, but there is a clear expectation of a large price swings in whichever direction the price do move. For example, thinking of a company that example like tobacco or pharma facing potential disastrous jury outcome. Either the jury outcome is good, then the sudden jump in the price can be very high, huge to the positive side. Or if the jury comes up with a verdict to the company, then could be a very large swing to downwards. Think of recent plain packaging rulings for the tobacco companies, right? Strangle strips and steps I'm not going to cover. So end of lecture week 7. I hope you all enjoyed this lecture. I've broken into 4 parts of it because it's quite a long lecture, and I've set some beautiful tutorial questions for this for you to practice, and we will discuss that next week. And you can, of course, come into Zoom to consult me in case you don't understand anything, or alternatively, you can email me. I've been replying all the emails. Thank you.